Hello, everyone. Recently, Time magazine published an essay by Professor Christopher Marquis titled, "Tax the Rich, They're Not Going Anywhere." It's a classic of the genre, and it relies on the usual academic suspects, London School of Economics and Christobal Young Studies, to suggest that the ultra-wealthy are basically sedentary creatures anchored to their zip codes by social stock and fancy restaurants. Well, I've spent 35 years dealing with ultra-high net worth families, and I can tell you, Christobal Young is half right, which makes him dangerously wrong. He's right that mere millionaires don't move. However, he's dead wrong about ultra-high net worth taxpayers. While academics are busy writing about why they won't leave, my phone hasn't stopped ringing with clients who are leaving. Today, we're going to look at the reality of how ultra-high net worth taxpayers have actually reacted to the UK non-dom changes and the California Billionaire Tax proposal. We're going to look at why a hot table at a San Francisco restaurant isn't worth a tax bill in the hundreds of millions or even billions of dollars. We'll also discuss how these taxpayers retain top legal counsel to design their fire escape plans and family offices which operate like Formula One pit crews to execute these plans. To understand if a taxpayer will leave, you don't need a sociology degree. All you need is a basic understanding of physics. I call it the migration equation. On the one side, you have the tax force. This is the additional cost of staying, imposed or proposed by a taxing jurisdiction. On the other side, you have life inertia. This is your connection to a place, your business, your social network, your kid's school, and yes, that near and dear table at your favorite restaurant. Now here's the reality that academics ignore. The wealthier you are, the higher the tax force and the lower the life inertia. A multi-billionaire tech founder in an era of email, Zoom, and Slack does not need to come into their California office every day to make and maintain their wealth. A 5% tax on their wealth is a significant tax hit. That is especially true when you take into account that this tax must be paid from the sale of assets for which the person has already had to pay capital gains tax. The predictable and now verified reality is that they will leave. In contrast, a Massachusetts dentist who's worth $2 million and facing a few additional percentage points of tax will probably not choose to leave. This is because the new tax burden is not enough to overcome their significant life inertia, which includes their business, patients, home, and family. For years, the non-dom system allowed wealthy foreigners to live in the UK and only be subject to UK tax on their UK income, capital gains, and UK-based estate assets for inheritance tax. As a result of the October 2024 budget, those individuals who remain in the UK became subject to income and capital gain taxes on their global income and gains. Most significantly, their heirs would now be subject to a 40% inheritance tax on their worldwide assets rather than just their UK assets. When Chancellor Rachel Reeves decided to tax the rich by making these changes, UK academics predicted a handful of departures. They were wrong. The exodus was large, public, and immediate. For example, Lakshmi Mittal, a steel magnate, is gone. Nassif Safiris, the richest man in Egypt and co-owner of Aston Villa, gone. Richard Node, CEO of Goldman Sachs International, gone. Why? Because the tax force wasn't just a few percentage points on income, it was a raid on their global capital and their children's inheritance. Since that budget, I've moved approximately 40 plus clients out of the UK with total net worth measured in the tens of billions of pounds and probably over 100 billion pounds. These individuals usually didn't move to tiny islands like Sark. They moved to Italy, lured by the 200,000, now 300,000 euro flat tax. Switzerland with its lump sum tax, the UAE with its zero personal tax, or a variety of other jurisdictions which offer a similar lifestyle to the UK but at a significantly lower burden. The LSE studies cited by Time interviewed people with an average worth of a few million pounds. Predictably, these academics found these people staying. This was unsurprising, given that interviewees were generally only getting income and capital gain from the UK and only had UK property. They had a significant amount of life inertia, and the tax changes did not increase their tax burden at all. In addition, the academics asked them if they would prefer small island tax havens to their homes in the UK. In short, they offered them boring little places rather than the life they could enjoy in Milan, Rome, or Capri. Now let's talk about the most recent real-world demonstration of the migration equation, California. The proposed 2026 Billionaire Tax Act is a 5% levy on the worldwide net worth of anyone worth over $1 billion. The proponents thought they were clever. They set an effective date of January 1st, 2026, hoping to sucker punch the billionaires before they could leave. However, what they didn't account for was the fact that the target of this proposal would engage top legal counsel to outline what they needed to do to leave California, and a highly organized family office to make it happen before the deadlines. Billionaires don't wait for a ballot in November of 2026. They hire people like me. In December 2025, while everyone else was eating turkey, my team was executing non-resident strategies for clients worth a collective of $800 billion. They didn't just threaten to leave, they executed clean departures. Look at Larry Ellison. He didn't wait to see if the tax would pass. He sold his $45 million Pacific Heights home in late 2025. He quietly moved his life center to Florida. Look at Sergey Brin and Larry Page. They've been transferring LLCs and moving entities out of the state for months. They aren't waiting to be sucker punched. They've already stepped out of the ring. Even Christabel Young, the sociologist the academics love to cite, admitted to the Atlantic magazine that this time is different. He said, "There's an anxiety in the air because this isn't just about income, it's about asset seizure." When the expert who wrote the book on why millionaires don't leave starts sounding the alarm, you know the wildfire is real. Proponents of these taxes often bring up the near and dear tests. They say the rich won't leave because their dog is here, their wine is here, their trophy case is here. They are right that the California Franchise Tax Board is aggressive. They will dig through your trash, they will check your Apple Pay, they will see where your dog sleeps. But here's the reality. It's much easier to move a dog and a wine cellar than it is to pay an enormous tax bill. If you are a tech founder whose wealth is tied up in stock, a 5% wealth tax isn't just a bill, it's forced liquidation. It forces you to sell your company shares, potentially losing a significant part of your equity in your baby, and potentially even forcing its liquidation. Those wealth tax proponents who glibly say they can afford to lose 5 cents on the dollar fail to understand the real-world impact of their proposal. First, the 5% is not based on the taxpayer's equity in the company. Rather, it's based on the voting shares. In many California-led founder companies, the founder reduces a percentage of their equity stake with each round of funding, but they maintain a majority of their voting shares. This is so that they can continue to guide the company that they founded and which their investors believe they will grow. Therefore, while a founder may only currently own 10% of the equity in the company, they often have 50% or more of the voting shares. If the company is worth $10 billion and their equity is worth $1 billion, they are subject to the wealth tax. However, assuming they hold 50% of the voting shares, their wealth tax bill will be 5% of $5 billion. That's $250 million. That's 25%, not 5% of their net worth. Furthermore, to pay their $250 million wealth tax bill, they need to sell shares in their company. However, that will be subject to a combined federal and state long-term capital gains tax rate of 37.1%. Therefore, the taxpayer will actually need to sell $342,750,000 worth of their shares to pay the $92,750,000 capital gains tax, which will net them sufficient funds to pay the $250 million in wealth tax. Therefore, their actual tax rate is not 5% or even 25%. It's over 34%. Finally, the sale of such significant amount of shares by a market maker such as this founder or insider is going to have a significant negative impact on the value of the shares. When a taxpayer is faced with this type of hit to their net worth, and the company they founded, it's easy to see why a decision to move to Austin, Texas, or Incline Village, Nevada, or Miami is almost inevitable. To wrap this up, the Time magazine article and the academic studies are based on old data and mere millionaires. They are irrelevant to the current tax the rich wildfire in places like the UK and California. When you propose a wealth tax, you aren't just taxing the rich, you're evicting the rich. When they go, they take their annual income taxes, their capital gain taxes, and their venture capital with them. California is already facing a massive budget hole. If even 10% of these billionaires leave, the resulting drop in annual revenue will be a catastrophe for a state that relies on the top 1% of taxpayers for 38% of its annual tax collections to pay for basic services to its residents. If you're watching this and you are in the crosshairs, my advice is simple. Do not wait for the ballot. Explaining a wealth tax to a low information electorate is hard. Tax the rich fits on a bumper sticker. The reality of capital flight doesn't. Prudence requires a fire escape plan. Whether you ultimately stay or go is a personal decision, but having the option to leave provides comfort. In life, hope that the wealth tax will not pass is not a strategy. Preparation is. I'm David Lesperance. If you want to build a strategy that survives the 2026 political tax wildfire, let's talk.